This LOS is calculate and interpret the intrinsic value of an equity security based on the Gordon constant growth dividend discount model or a two-stage dividend discount model as appropriate. The Gordon growth model. So this is a dividend discount model where we assume a constant growth rate, and the formula, sometimes we see it as V naught or sometimes as P naught. Nevertheless, P naught equals D1 over R minus G, and sometimes we see that as K as well, but never mind about the nomenclature, okay? And so the D1, is our dividend today times 1 plus the growth rate. So again, with these types of questions where you need to calculate, sometimes there's a number of little sub-calculations that you have to make. Now, the other thing to realize is that R is the required or expected rate of return on the equity, and we can use the cap M in order to calculate that. So again, you can see a number of sub-calculations that we need to do given certain bits and pieces of information to come up with a valuation. We might have to calculate R first using cap M. We might have to calculate then next G, and G, remember, is the retention rate times ROE. We saw that before, okay? G equals the dividend growth rate, and B, in this nomenclature, is the earnings retention rate, which is 1 minus the dividend payout ratio. And then ROE, of course, going back to our accounting, we can use the DuPont. So it's net income over equity. ROE is also equal to the return on assets times leverage, which is net income over assets times assets over equity. The assets cross out, again, net income over equity. Or it can be expanded, the expanded DuPont to the next level is profit margin times asset turnover times leverage. So ROE is net income over sales times sales over assets times assets over equity, which gets us back to our net income over equity. Okay, so in the next series of questions, you're going to see that you have to be very up to speed, and speed is a skill. Skill gets rewarded, that you're given bits and pieces of information. You need to do a couple of sub-calculations and then tie it all together in terms of calculating the P naught or the V naught, okay, the value or the price. Okay, I always say the best way to prepare for the CFA exam is to do as many practice questions as possible. So let's just jump into one right here. An analyst gathers the following data for a company to estimate the expected growth rate of dividends and use it as an input for valuing the company's common stock. So we've got the return on assets 10%, the profit margin 5%, the financial leverage at 1.67, and the payout ratio at 25%. So the company's expected growth rate is closest to A, 4.2%, B, 6.3%, or C, 12.5%. Okay, again, as I said, we're looking for G. We're going to calculate G. So one of the formulas for G is the retention rate times the ROE. Well, the retention rate is easy. We've got the payout ratio at 25%, so 1 minus 0.25, we're going to have a retention rate of 75%. So that's the easy one. Now, the next thing that we need is the ROE. Now, we know ROE is ROA times financial leverage, and they're giving us the ROA 10%, and they're giving us the financial leverage 1.67. So 10% times 1.67 is 16.67%. So now we can calculate our G, which is retention rate times ROE, 0.75 times 16.67, and we get the correct answer is C, which is 12.5%. So this is a nice little warm-up question. Again, you have to be good on understanding the formulas and then looking what they're giving to you, looking what you need to calculate, and then running through a number of steps. And this one wasn't too difficult. G equals retention rate times ROE. It was easy to calculate the retention rate, and the ROE, they're giving us DuPont information. Okay, nice little question to get started with. Okay, the next practice question. An analyst gathers the following information about a company. So we've got a net profit margin 8%, return on assets 10%, financial leverage, assets over equity of 2.5. We have a beta for the company stock 1.5, expected rate of return on the market index 10%, and the risk-free rate of return of 5%. So what is the question asking us? The analyst expects the information above to accurately reflect the future. If the company wants to achieve a growth rate of 15% without changing its capital structure or issuing new equity, the company's maximum dividend payout ratio in terms of percentage is closest to A, 25%, B, 40%, or C, 60%? Okay, this is a nice question. I really like this one. These are like little math puzzles. So what's it asking for us? It's asking for the payout ratio. So we know the payout ratio is 1 minus the retention rate. Okay, that's going to give us the payout ratio. Then, retention ratio, where do we see that? G equals the retention ratio times ROE. So G equals retention ratio times ROE. We can do a little bit of algebra there. So the retention ratio equals G divided by ROE, okay? And in this question, they're giving us the G, okay? It's here, so you have to read very carefully. It says if the company wants to achieve a growth rate of 15%. So they're giving us G equals 15%, okay? So now I've got my 15%, and for the ROE, I can calculate my ROA times the leverage. And they're giving us ROA, and they're giving us the leverage. There's the financial leverage, and there's the return on the assets, okay? So again, let's go through these steps right here. 1, ROE equals ROA times financial leverage. So that's 10% times 2.5, so it's 25%. The retention ratio equals G over ROE, so it's 15% divided by 0.25 equals 0.6. So the retention ratio is 60%. That means the dividend payout ratio has to be 40%. So the payout ratio, 1 minus the retention ratio, 1 minus 0.6 equals 40%. So a very nice question. Give that kind of a 5-star because they're giving you all kinds of data and you're having to calculate now what the payout ratio is. And really, you know, when you go through this, it wasn't that difficult. You had to go through a couple of steps, but you had to know where to start. So, you know, based on what was given. Excellent little question. These just take lots of practice, and seeing as many practice questions as possible gets you better and better at these, quicker and quicker, kind of knowing what I need to do to work my way through it. Again, another practice question. An analyst gathers the following data about a company: stock price $40, stock's required return 12%, consensus estimate of next year's dividend $2, and the company's return on equity is 10%. Using the dividend discount model, the company's dividend payout ratio is closest to A, 5%, B, 30%, or C, 70%. Okay, in terms of the CFA continuum of questions, I would say that this is a fairly difficult one unless you're a super duper math lover. But let's just go through it again. So again, we're going to start with G equals, we're looking again for the company's dividend payout ratio. So G equals the retention rate times the ROE. So if we can somehow get to our retention rate, then we'll be able to calculate the payout ratio, okay? And also, so we've got G equals retention rate times ROE, and also we're working with this formula P naught equals D1 over R minus G, okay? So they're giving us the stock price, they're giving us the consensus on D1, that's next year's dividend, okay? So let's just work through this problem. So starting with P naught equals D1 over R minus G, 1, 2, 3, 4 variables. Given 3, we can solve for the 4th. So you can see here, we're going to solve for G first. And that's why I said these kind of little math puzzles are a bit tricky at first. So $40 equals $2 dividend divided by 0.12 minus G. So 4.8 minus 40G equals 2. 40G equals 2.8. G equals 0.07. Now you can go up to this formula. G 0.07 equals the retention rate times ROE. Aha, they've given us the ROE at 10%. So now we're just solving for the retention rate. Retention rate is going to be 0.7, okay? And then it's easy to get the payout ratio. 1 minus the retention rate equals 30%, so the correct answer is B. As I sometimes like to laugh and joke, when in doubt, guess B. You've got a 30% probability of being right, okay? Now, that's not too difficult. If you go back and look at the math, you'd say, well, that's really easy. The issue is knowing where to start with the question, and it's just CFA 101, 1, 2, 3, 4 variables, given 3, solving for the 4th, and then using that again in another formula to solve for the unknown, okay? Again, these questions get easier the more practice that you do. I give this a 5-star question, excellent little question, excellent little practice, taking you through your paces with regards to the interaction between different formulas. Another practice question: an analyst gathers the following data to determine the attractiveness of the company's common stock. So the dividends per share in 2002 were $2. The dividends per share in 2008 were $3. The expected return on the market is 17%. The expected nominal risk-free rate is 9%. The stock's beta is 1.8. And the stock's market price as of January the 1st, 2009 is $19. So using the constant growth dividend discount model, the stock's intrinsic value is closest to A, $12.82, B, $18.29, or C, $19.57. Okay, this is a nice little question because, again, it brings in a new sort of trick and that you need to do in terms of a calculation. And in this case, we need to calculate G, all right? There's a little trick to it. They're giving us the dividends per share in 2002, and they're giving us the dividends per share in 2008. And from that, we're going to calculate G. So again, I always say, fool me once, shame on you. Fool me twice, shame on me. Once you start to see these little tricks, then, there's only so many different ways to spin a question. You start to see the same things over and over. And that's why by doing as many practice questions as possible, you start to see things, okay? And then when you see the same type of question, similar but different, you know how to approach it, how to start with it. So again, we're asking to use the Gordon Growth Constant Dividend Discount Model to calculate the stock's value. So we know P naught equals D1 over R minus G. So we need this G, okay? And also the dividend, we've got the 2008 dividend, we need the 2009. So we know that, we've got the dividend D naught is $3. We need to multiply it by 1 plus G, so we need the G rate, G again. So how can we do it? It's a little bit tricky. You need the compound annual average growth rate for G and also the CAPM for the R. So that's the other thing that we needed to do. So let's start with the CAPM first. The CAPM in terms of the R, that's going to be the risk-free rate plus the beta times the return to the market minus the risk-free rate, okay? So make sure that that's not a market risk premium. That's the other trick that they like to do. And if you take the market risk premium and subtract the risk-free rate, you're going to make a mistake. But this is the return on the market. So the CAPM should be very easy in terms of calculating the R. 9 plus 1.8 times 17 minus 9, you're going to get 23.4 for the R, okay? So that's 23.4%. And now for the G, as I said, there's two ways to do it. You can do 3 divided by 2 to the power of 1/6 for the compound annual average growth rate, because you started in 2002, 3, 4, 5, 6, 7, 8. So you see 1, 2, 3, 4, 5, 6. So it's fairly easy. 3 divided by 2 to the power of 1/6. Or, if better safe than sorry, you could do present value equals 2, future value equals -3. One has to be negative. N equals 6. And compute the IY. Anyhow, nevertheless, in terms of the G, you're going to get 7%. Now you're off to the races for the formula. You're going to do $3 times 1.07 for the numerator. And for the denominator, you're going to do 0.234 minus 0.07, okay? And so here it is here, the value, 3 times 1.07 divided by 0.234 divided minus 0.07. We're going to get $19.57. Correct answer is C, okay? So not too difficult. Again, all the math is really easy, and you understand all this, how to use the CAPM to calculate the R, how to calculate the G. The math was all easy. The tricks with this is knowing what they're giving you and knowing where to start first. What's my step 1, my step 2? Which formulas do I need to use to work my way through the various steps to come up with the correct answer? And, again, not too difficult, but it takes a little bit of practice. Okay, another practice question. An analyst attempting to value the shares of a company has gathered the following data: return on equity 12%, dividend payout rate 40%, required rate of return on shares 15%, and the current year's dividend per share $3.60. Using the Gordon Growth Model, the intrinsic value per share is closest to A, $36.96, B, $46.15, or C, $49.49. Okay, I think this one is a little bit easier. We're going to do V naught equals D1 over R minus G, okay? So you can see they're giving us the return on equity, and G equals retention rate times ROE, okay? So I think you see that how you're going to get the hang of this. And the payout ratio is 40%, so you know that you don't even need a calculator, the retention rate is 60%. So G equals going to 0.6 times 0.12, correct? So if I just bring up the calculator very quickly, 0.6 times 0.12, I've got a G of 0.072, okay? So G equals 0.072 or 7.2%. So that's easy. Let's just go here. G equals retention rate times ROE. Retention rate equals 1 minus the payout ratio. So that's 1 minus the 0.4, 0.6. So G equals the 0.6 times the 12%, 7.2%. Now I've got my G, so I've got my current year dividend, $3.60. We know D1 equals D naught times 1 plus the G. So we can get our D1. It's going to be $3.60 times 1 plus the growth rate. So if I add 1 to this and I multiply by $3.60, I'm going to have my D1 3.8592. Okay, so my D1 is 3.8592, correct? I've got that, well, you can see the rounding there to 0.86. And I've got my R. It was nice. They gave it to us, the required return. I didn't have to use my cap M or anything. So I'll just make it down here. 3.86, just a little bit of rounding, divided by 0.15 minus the G, 0.072. So again, I'm just going to finish this off. 0.15 minus 0.072. You can see my denominator is 0.078, okay? So so I'm going to have, just make a little bit of space over here, 3.86 divided by, what did I say that was? 0.078. 0.078. So I'll just bring up my calculator again, and 3.86 with my rounding divided by 0.078, and I've got the correct answer, 49.87. Just check and double check. So that is closest to 49.487, closest to C, 49.49. Okay, so that question I think was a little bit easier. Maybe I should have started this one and worked our way up. But as you can see, again, it's all these questions are given certain bits and pieces of information. Given 1, 2, 3, 4 variables, given 3, solve for the 4th. Use that in your next series of calculations, eventually getting to what you need to calculate. I think that one, they're getting easier now. You can see that. Okay, now we're moving on to the multi-stage dividend discount model. And multi-stage growth models are often used to model rapidly growing companies. The two-stage dividend discount model assumes that at some point the company will begin to pay dividends that grow at a constant rate. But prior to that time, the company will pay dividends that are growing at a higher rate than can be sustained in the long run. That is, the company is assumed to experience an initial, finite period of high growth, perhaps prior to the entry of competitors, followed by an infinite period of sustainable growth. The two-stage dividend discount model thus makes use of two growth rates, a high growth rate for an initial, finite period, followed by a lower, sustainable growth rate into perpetuity. The Gordon growth model is used to estimate a terminal value at time n that reflects the present value at time n of the dividends received during the sustainable growth period. Okay, what are they talking about that? So in terms of the valuation, we're going to have the dividend, and it's 1 plus the growth rate, the initial growth rate, okay, divided by, and they're discounted back, but we still need this terminal value. And with the terminal value, we're assuming that the growth rate is going to settle down into a sustainable growth rate, so we can use the Gordon growth model. So the valuation at time n is the dividend n plus 1 divided by r minus g, okay? And that's how we come up with the terminal value. Again, this is going to be easier to see through an example that we're going to do on the next slide. So again, P naught equals D1 over R minus G. Therefore, P3 equals D4 over R minus G, and that's what we're talking about. Let's say that Vn was 3 years from now, we would do D4 over R minus G. So the value of P3 at time 0, then we would discount that back using our discount rate. So P3, we would discount that by 3 years, and that's how we would, because our intrinsic value is being discounted back to time 0, all right? So sometimes we see V naught in the formula, sometimes we see, Vn, Pn, V naught, P naught, doesn't matter. Anyhow, let's go through an example on the next slide, and this will be, the two-stage model is not difficult, it's just a little bit more math. At the end of the day, fairly easy to understand. Okay, let's walk through this example of the multi-stage dividend discount model. So the current dividend is $5, and growth is expected to be 10% a year for 3 years, and then 5% thereafter. And the required rate of return is 15%, so that's what we're going to discount everything back by. And we need to calculate the intrinsic value of the stock. So we can see this is a two-stage model. There's growth at 10% for 3 years, and then it's 5% thereafter. So here's the formula, but let's not be too worried about the algebraic formula for now. Let's just think about what we need to do. We need D1, we need D2, and we need D3, because that we're going to calculate the present value of the dividends, okay? And then, that's present value of the dividends. We also need then the present value of the terminal value. And this is what they're saying, the terminal value, we're going to use the Gordon growth rate model, okay? And so we're going to be able to calculate P3 is going to equal D4 over R minus G, okay? And we know G at that point is going to be 5%. So how are we going to get that D4? It's going to be D3 times 1.05, that 5% after the 3 years, and we're going to be able to calculate the D4. So I think this is becoming clear to you. And then of course that P3, we're going to discount that back for 3 years at the 15% rate, okay? So I think this is becoming clear that this is not too difficult a question. Calculate D1, calculate T2, calculate D3, calculate D4. That's using the new growth rate. Then do the present value of the dividends and the present value of the terminal value using the growth rate, D4 over R minus G, G using the new growth rate, okay? So let's just bring up the calculator and get the data that we need. I see that there's lots of math here, but it's really just present value calculations. So we have a $5 dividend, and it's going to grow by 10% for 3 years. So times 1.1, D1 is going to be $5.50. And indeed, we see that here. Here's the algebra. $5 times 1.1 to the power of 1, $5.50, okay? But if I just multiply it again times 1.1, the easy way, we're going to have D2 of 6.05. So we've got D2 of 6.05, or if you want to see a little bit more fancy algebra, 1 plus 10% to the power of 2 times the $5, okay? Bringing up the calculator again, multiply by 1.1 for D3, and we're going to have 6.655, okay? 6.655 for my D3, and indeed I have it here, which is 1 plus 10% to the power of 3 times the $5, 6.655, okay? And you can see what I'm doing here is I'm just doing the present value of those dividends. So there's the present value of the first dividend, there's the present value of the second dividend, and there's the present value of the third dividend. Now for the fourth dividend, pay attention here, we're not multiplying by 10%. This is where the growth rate changes to 5%. So I'm going to multiply by 1.05, and that's the key thing. So now I've got my D4, 6.98775. So my D4, 6.98775, okay, which you can see I've calculated here. As I said, it's the $5 times 1.1 to the power of 3, and then times the 1.05. Or, as I said, it's just D3 times 1.05. Very easy peasy. So now we know, given that, that's our D4. We can calculate our P3, D4 over R minus G. So we're doing that right here. And you can see that's where we've got our V3, 6.98775 divided by 15% required return minus our new growth rate, which is 0.05. So if I just bring up the calculator very quickly, we can see there's our 6.98775. That's my D4. Actually, I'm dividing by 0.1, which is 15% minus 5%, and I'm going to get 69.8775. So that's my terminal value at P3, and then I have to discount that back to times 0, though, okay? And that's what that number is. That's just dividing back by 1.15 to the power of 3. So therefore, again, I won't bring up the calculator to do all the math, but you can see, what am I doing here? I'm doing the present value of the first dividend, present value of the second dividend, present value of the third dividend. Then I calculated the terminal value, and I calculated the present value of that. And here I add it all up. So there's the present value D1, present value D2, present value of D3, plus the present value of my terminal value, and I get 59.6788. Okay, not too difficult, just takes a little bit of practice. The issue with these questions is knowing that, for how many years am I in the first stage of growth, and then after that, that's when I get to my stable set of growth. So to do the terminal value, in this case, it was for 3 years, so I'm going to calculate P3. That's based on D4 over the R minus G. So it just takes sometimes a little bit of practice getting your years right. Anyhow, that's the last slide for this LOS. Been a bit of a long LOS, but a good one. And that's it. Thank you.